Double Entry Principle on Accounting Expo with Abisola Abeke, your SabiTeacher.
Remember, accounting is just storytelling with numbers. Every transaction has a giver and a receiver, and your job as an accountant is to record both sides correctly. Imagine this for a second. You bought snacks worth 1,000 naira and paid cash. If I ask you to record it, which two sides of your life would it affect? Your pocket and your appetite. Every time money moves, there is a take and there is a take. That's exactly what happens in accounting. Every transaction has two sides. Let's explore how in accounting nothing hides. Every debit has a matching credit. If you can spot the give and take in each transaction, you've mastered the accountant's golden rule. That's the secrets accountants have been using for centuries. The double entry principle. This says every transaction has two sides. One account receives value and the other gives value. But here is the fun part in business. Every naira leaves a trail. Come to the world of double entry principle on Accounting Expo with Abisola Abeke, your Sabi teacher. Thank you and God bless you.
The topic we shall be looking at is the double entry principle. And our learning objective for this topic are: at the end of the lesson, you should be able to explain the meaning of double entry principle, identify the two accounts involved in a transaction, apply the double entry principle in the transaction, and show the ledger entries. Now, what is the double entry principle? The double entry principle is the principle that says that every business transaction affects two accounts, in which one account is debited and the other account is credited by the same amount. This means that for every value received, there must be a value given out. In other words, it shows that every debit entry has a corresponding credit entry. Now let's look at the 5 major elements of accounting. We have assets, liabilities, owner's equity, revenue, and expenses. So when there is increase in assets, we debit, and when there is decrease in assets, we credit. So what is an asset? Asset is any tangible or intangible item owned or controlled by a business, which has economic value that can be realized by either converting it to cash or generating income for the company. Liabilities, on the other hand, is any kind of financial obligation that a business has to pay at the end of an accounting period to a person or a business. Liabilities are settled by transferring economic benefits such as money, goods, or services. And when there is decrease in liability, we debit it, and when there is increase, we credit it. Now to owner's equity. When there is decrease in owner's equity, it is debited, and when there is increase, it is credited. Owner's equity is the amount of capital invested or owned by the owner of a company. The equity is evaluated by the difference between liabilities and assets recorded on the balance sheet of a company. Revenue or income, on the other side, is also revenue, also called income, is the amount of money brought into the business, typically by selling goods, products, or services. When there is increase in revenue, it is credited, but when there is decrease in revenue or income, it is debited. Expenses is the operational cost that is paid to earn business revenues. When there is increase in expenses, it is debited, but when there is decrease in expenses, it is credited. Now, accounting equation. Now let's look at this example of transaction cash, where a business organization buys goods worth 50,000 naira on credit from Tola stores. Here we are to identify the two accounts involved in the transaction, apply the double entry principle, and then show the ledger entries. Now, the two accounts involved are purchases accounts and Tola stores accounts, because the business bought goods from Tola stores on credit. So goods bought to resell is known as purchases, and the organization from whom the goods were bought on credit was Tola stores. Now, in order to identify the account to be debited and the account to be credited, let's look at increase in assets and liabilities. Now, for this transaction, there was an increase in the stock of goods the company has because they bought additional goods for resale. So, and whenever there is increase in assets, such assets will be debited. So purchases will be debited. Also, the transaction led to increase in the financial obligation of the business to Tola stores. So since there was an increase in the firm's liability to Tola stores will be credited with the amount involved. In order to show the ledger entry, purchases account, the account name. On the debit side, left hand side we have DR, which is the debit side. Right hand side is the credit side, which is the CR side. So when to indicate that purchases account is being debited, Tola stores will be written inside the particular column on the debit side of purchases account. Now, Tola stores is on the debit side and the amount of 50,000 naira equally written under the currency sign, which is 50,000 naira. Now, for Tola stores, equally for Tola stores, Tola will be written as the account name. The left hand side is the debit side, the right hand side is the credit side. Now, inside the account, on the credit side of Tola stores ledger, purchases will be written in the particulars column of the credit side, and 50,000 naira will be written in the currency sign on the credit side of Tola stores account. Now, let's look at the practice question. From these practice questions, you are required to highlight the account to be debited and the account to be credited, then show the ledger entries, while I will identify the two accounts involved. So for the first transaction, pay 10,000 naira cash to landlord for rent. For that transaction, the two accounts involved is cash and rent. So for the next one, bought goods worth 25,000 naira on credit from Tola stores. For this transaction, we have purchases and Tola stores. The next transaction, sold goods on credit to Musa. We have Musa Enterprises account and sales account. For the next one, return goods worth 5,000 naira to Tola stores. For this, we have stock of goods return, which is return outwards, which will be represented by return outwards, and Tola stores. So for the next one, pay salaries of 20,000 naira by check. For this, we have salaries and bank accounts. Now, Musa Enterprises return goods worth 20,000 naira to us. For this transaction, we have Musa Enterprises, who is a debtor, naira cash. Receive 12,000 naira cash from a debtor Ayo. For this, here we have cash and Ayo's account. Next, which happens to be the last one, bought office equipment for 30,000 naira and paid cash. In this case, we have office equipment. Now that you know that every transaction has two sides, it's time to test your detective skills. Grab a transaction cash, find find the giver and find the receiver, and then decide which one gets the debit and which one takes the credit. Remember, accounting isn't just about numbers, it's about stories. Every debit and credit tells the story of how money moves in a business. If you have found this helpful, tag a friend who loves accounting or business. And if you are learning with me, get ready, because here at Accounting Expo with Abisola Abeke, your Sabi teacher, we don't just study accounting, we live it, we apply it, and make it fun. Welcome on board, and don't forget to like, share, and subscribe to Accounting Expo with Abisola Abeke, your Sabi teacher, for more lessons that makes accounting simple, relatable, and exciting. And do not forget to practice the question and drop your answers in the comment section, and I'll give you feedback. Have a great day and bye for now.